What if I told you the engine of the world's economy is seizing up? For 30 years, China's unstoppable growth was more than just a headline. It was a law of economic physics. But what happens when that law is broken? Right now, two foundational pillars of China's miracle are crumbling simultaneously, and the fallout threatens to bring the whole structure down. A mountain of debt so vast it defies imagination, and a demographic cliff so steep it's unprecedented in modern history. This isn't just a China problem. This is a global problem. Today we're going deep into the anatomy of the world's biggest property bubble, and the ghost of the one-child policy that's haunting China's future. Firstly, a self-inflicted crisis born from building cities for people who aren't coming, leaving a landscape of ghost towers and shattered middle-class dreams. Secondly, a workforce that is shrinking by millions every year, a generation of youth facing crushing unemployment, and a population in freefall. This is the story of the two bombs that are tearing China apart. And by the end, you'll understand exactly why the next 18 to 24 months will determine whether China remains an economic superpower or enters a lost decade that reshapes the global economy. Section 1. The debt trap. To understand the debt, you have to understand the dream. For the average Chinese family, property wasn't just a home. It was the only reliable path to wealth. After the 2008 financial crisis, while the West was deleveraging, China did the opposite. It unleashed a tidal wave of credit, a stimulus package of historic proportions. Local governments were incentivized to build, and they did. Highways, airports, bullet trains, and apartments. Millions of them. Property values soared. It created a powerful belief: real estate only ever goes up. Developers, seeing this insatiable demand, borrowed recklessly to grab more land and build even faster. It was a self-perpetuating cycle, a bubble of epic proportions. But every bubble has a pin. Enter Evergrande. At its peak, it was the world's most indebted property developer. Its business model was simple: borrow huge sums, sell apartments before they were built, and use that cash to start the next project. The problem? It only works if the music never stops. In 2020, Beijing got nervous. It saw the systemic risk and introduced the 3 red lines policy, a set of strict debt limits for developers. For Evergrande, this was a death sentence. The easy credit dried up. Construction on its 1.5 million unfinished homes ground to a halt. Suddenly, the company that once symbolized China's rise was facing over $300 billion in liabilities. After years of struggling, a Hong Kong court ordered its liquidation in early 2024. But Evergrande wasn't the only one. Country Garden, once considered a model developer, is now on the brink, facing a similar fate. Section 2. The human cost. The human cost is immense. An estimated 20 million homes were pre-sold but remain unfinished. That's millions of families whose life savings have simply vanished into these concrete skeletons. But the visible debt of developers is only half the story. The really scary part is the debt you can't see. Meet the LGFV, local government financing vehicles. Imagine your city's mayor wants to build a new stadium, but they're legally barred from borrowing more money. So they create a separate company that looks private. Let's call it the Stadium Development Fund. This fund borrows billions from banks and investors. The city uses that money to build the stadium. But if the fund can't pay its debts, well, everyone knows the city, and its taxpayers are secretly on the hook. Now multiply that by thousands of cities and towns across China. This shadow banking system holds an estimated $7 to $11 trillion in hidden debt. It's a black hole at the heart of China's financial system, leading us to the second bomb. If the debt bomb is an explosion, the demographic crisis is a slow, creeping poison. For 36 years, the one-child policy brutally reshaped Chinese society. It was brutally effective at curbing population growth, but its ghost now haunts the nation's future. It created what's known as the 4-2-1 family structure. One child responsible for supporting 2 parents and 4 grandparents. Even after the policy was scrapped in 2016, the trend couldn't be reversed. In 2023, China's population fell for the second year in a row, losing over 2 million people. Its fertility rate is now just 1.0 births per woman, far below the 2.1 needed to maintain a stable population and one of the lowest on Earth. The population is projected to shrink by over 100 million people by 2050. Section 3. The Japan comparison. So we have to ask, is China the new Japan? We've seen this movie before. In the 1990s, Japan's property bubble burst, leading to decades of economic stagnation, known as the lost decades. A key ingredient? A rapidly aging and shrinking population. China's trajectory looks eerily similar, but with a terrifying difference. Japan was already a wealthy, developed nation when its crisis hit. China is getting old before it got rich. This economic pressure has created a crisis of spirit among China's youth. Officially, the urban youth unemployment rate for ages 16 to 24 hovers around 15%, after the government changed how it calculates the data. Unofficial estimates from economists suggest the real number could be much higher. And here's where it gets truly dangerous. These two crises aren't happening in isolation. They are locked in a death spiral, a doom loop where each problem makes the other one infinitely worse. Step 1. The demographic cliff means fewer young people forming families. Step 2. Fewer families means less demand for new apartments. Step 3. Less demand crashes the property market, bankrupting developers. Step 4. The property crash wipes out household savings, killing consumer confidence. People stop spending. Step 5. A weak economy means fewer jobs and lower wages for young people. Step 6. Job insecurity and financial pressure mean young people delay marriage and have even fewer babies. Which brings us back to step 1. Section 4. The confidence trap. This is the ultimate trap. To fix the debt, you need economic growth. But to get growth, you need confident consumers and a growing workforce, the very things China no longer has. It's a crisis of confidence, and confidence is the one thing a government can't print. For decades, the world bet on the Chinese consumer. German car makers like Volkswagen and BMW sell more cars in China than anywhere else. French luxury brands like LVMH depend on Chinese shoppers. Australian mining companies exist to feed China's construction appetite. When the Chinese stop buying, the shockwave is felt everywhere. The IMF has warned that a sharp slowdown in China could shave nearly a full percentage point off global GDP growth. Remember the Belt and Road Initiative, China's ambitious plan to fund trillions in infrastructure across Asia, Africa, and Europe. With a budget crisis at home, where will the money for these projects come from? Many developing nations that bet their future on Chinese loans are now facing a very uncertain reality. And it hits your wallet. Many global pension funds and investment portfolios have exposure to Chinese markets. A prolonged downturn in China will drag down global stock indices. And the disruption to supply chains, from iPhones to pharmaceuticals, could mean more inflation and uncertainty for years to come. If you're finding this valuable, make sure to subscribe to the channel. We're connecting the dots on the biggest economic stories that will shape your financial future. Section 5. The policy response. This brings us to the ultimate question: can Beijing stop the bleeding? The bull case is that the government has total control. It can force state-owned banks to absorb losses. It can command state companies to buy up empty apartments to prop up the market. But these are just short-term fixes that kick the can down the road, potentially creating an even bigger zombie economy. The bear case is that this is a crisis of confidence that no decree can solve. The social contract in China was simple. We'll trade freedom for economic prosperity. But when that prosperity vanishes, what's left? The era of China's miracle growth is definitively over. The world is now watching to see if it's replaced by a soft landing, a Japanese-style lost decade, or something much, much worse. Let's look at what Beijing has tried so far. In response to the property crisis, the government has implemented several measures. They've reduced down payment requirements for home purchases. They've lowered mortgage rates. They've eased restrictions on home buying in many cities. Local governments have been encouraged to buy unsold apartments and convert them into affordable housing. State-owned enterprises have been directed to purchase properties from distressed developers. But none of these measures have reversed the fundamental problem. There are too many apartments and not enough people who want or can afford to buy them. The government has also tried to stimulate consumer spending. They've issued consumption vouchers. They've reduced taxes on certain goods. They've encouraged banks to lend more to consumers. Yet household savings rates remain stubbornly high. Chinese families are saving more, not spending more, because they're worried about the future. Section 6. The structural problems. This reveals a deeper structural problem. China's economic model has been built on investment and exports, not consumption. For decades, household consumption has represented only about 38% of GDP, far below the 68% in the United States, or even the 55% in other developing economies. This means the Chinese economy is heavily dependent on building things, infrastructure, factories, apartments, rather than on people buying things. But you can only build so many apartments before you run out of people to live in them. You can only build so many factories before you run out of things to produce. And when the building stops, the entire economic model breaks down. The demographic crisis makes this structural problem even worse. With fewer young people entering the workforce, there are fewer people earning incomes and fewer people consuming. The working age population in China peaked in 2015 and has been declining ever since. By 2030, China will have lost approximately 70 million working age people. That's 70 million fewer workers producing goods, paying taxes, and consuming products. It's 70 million fewer people to support an aging population that's growing rapidly. By 2040, China will have approximately 400 million people over the age of 60. That's more than the entire population of the United States. Who will support them? Who will pay for their healthcare, their pensions, their social services? The answer is a shrinking workforce that's already struggling with unemployment and stagnant wages. Section 7. The productivity challenge. Some economists argue that productivity gains can offset demographic decline. If each worker becomes more productive, you need fewer workers to generate the same economic output. This is theoretically true, but it requires massive investments in education, technology, and innovation. And it requires time, something China may not have. China's productivity growth has already been slowing. Total factor productivity, a measure of how efficiently an economy uses its inputs, has been declining since 2010. This suggests that China is getting less output from each unit of capital and labour it invests. The easy productivity, gains from moving workers from farms to factories, have already been captured. The next phase of productivity growth requires moving up the value chain, from manufacturing low-cost goods to producing high-tech products and services. But this transition is proving difficult. China faces several obstacles. First, the trade tensions have limited access to advanced technologies. Export controls on semiconductors and other critical technologies have made it harder for Chinese companies to acquire the tools they need to innovate. Second, the education system, while producing millions of graduates, hasn't kept pace with the economy's changing needs. There's a mismatch between the skills workers have and the skills employers need. Third, the regulatory environment has become more unpredictable. Crackdowns on tech companies, education firms, and other sectors have created uncertainty that discourages innovation and investment. And fourth, the demographic crisis means there are fewer young people, the age group that typically drives innovation and entrepreneurship. Section 8. The consumption problem. Let's return to the consumption problem because it's central to understanding China's economic challenges. For China to transition from an investment-led economy to a consumption-led economy, household consumption needs to rise from 38% of GDP to something closer to 50% or 55%. That would require an increase of approximately $2 to $3 trillion in annual consumer spending. Where would that money come from? Theoretically, it should come from higher wages. If workers earn more, they can spend more. But wages in China have been growing slowly, and in some sectors, they've been stagnant or even declining. Why? Because companies are struggling with overcapacity, falling prices, and weak demand. They can't afford to raise wages when their profit margins are already thin. The property crisis has made this worse. For most Chinese families, their home represents 70% to 80% of their total wealth. When property values fall, household wealth falls, and people feel poorer. When people feel poorer, they spend less and save more, exactly the opposite of what the economy needs. The government could try to boost consumption through fiscal transfers, directly giving money to households. Some economists have proposed this, but the government has been reluctant to do this on a large scale. Why? Because it would require running larger budget deficits, which would increase government debt. And the government is already concerned about debt levels, particularly the hidden debt in local government financing vehicles. This creates another doom loop. The government is reluctant to increase spending because of debt concerns. But without increased government spending, consumption remains weak. And weak consumption means weak economic growth, which makes the debt problem worse. Section 9. The deflationary spiral. One of the most concerning developments in China's economy is the emergence of deflationary pressures. In 2023 and early 2024, China experienced periods of deflation, when prices actually fall rather than rise. This might sound good if you're a consumer, but it's actually very dangerous for an economy. When prices are falling, consumers delay purchases because they expect things to be cheaper in the future. This reduces demand, which forces companies to cut prices further, which reduces their revenues and profits. Companies respond by cutting costs, laying off workers, reducing wages, cancelling investments. This reduces incomes, which reduces demand further, which puts more downward pressure on prices. It's a vicious cycle that's very difficult to escape. Japan experienced this for 2 decades after its bubble burst in the 1990s. China's deflation has been driven by several factors. Overcapacity in manufacturing means companies are producing more than consumers want to buy, forcing them to cut prices. The property crisis has reduced wealth and confidence, causing people to spend less. And weak global demand has reduced export opportunities. The government has tried to combat deflation by cutting interest rates and encouraging banks to lend more. But these measures have had limited effect because the fundamental problem is lack of demand, not lack of credit. You can make borrowing cheaper, but if people don't want to borrow because they're worried about the future, lower interest rates won't help. Section 10. The global implications. China's economic slowdown has profound implications for the global economy. For the past 2 decades, China has been the primary engine of global growth. According to the World Bank, China accounted for approximately 30% of global GDP growth between 2013 and 2023. If China's growth slows significantly, global growth slows with it. For commodity exporters, countries like Australia, Brazil, Chile, and many African nations, China's slowdown is already being felt. Demand for iron ore, copper, soybeans, and other commodities has weakened, putting pressure on prices and export revenues. For manufacturing exporters, countries like Vietnam, Thailand, and Mexico, China's slowdown has mixed effects. On one hand, weaker Chinese demand hurts their exports. On the other hand, some manufacturing is shifting out of China to these countries, creating new opportunities. For developed economies, the United States, Europe, Japan, China's slowdown means weaker export markets and potential financial market volatility. But it also means less competition in some sectors and potentially lower inflation as Chinese goods become cheaper. The most significant global impact may be financial. If China's property crisis triggers a broader financial crisis, it could spread through global financial markets. Chinese banks and financial institutions have significant international exposure. A crisis in China could affect banks and investors around the world. Moreover, if China responds to its economic problems by devaluing its currency to boost exports, it could trigger competitive devaluations by other countries, leading to currency instability and trade tensions. Section 11. The timeline. So when does this all come to a head? The honest answer is it's already started. We're in the early stages of what could be a prolonged slowdown. Here's what the next few years probably look like. 2026. The property crisis continues to unfold. More developers face financial distress. Local government finances deteriorate further as land sales, a major source of revenue, remain depressed. Youth unemployment remains elevated. Consumer confidence stays weak. The government implements more stimulus measures, but they have diminishing returns. 2027. The demographic crisis becomes more acute. The working age population shrinks noticeably. Pension and healthcare costs rise. The government faces difficult choices about how to fund social programs with a shrinking tax base. Some local governments may face debt crises, requiring bailouts from the central government. This increases the overall government debt burden. 2028 to 2029, the economy settles into a new normal of much slower growth, perhaps 3% to 4% annually, instead of the 6% to 8% of the past decade. This slower growth makes it harder to manage debt levels, as debt to GDP ratios rise even if absolute debt levels stabilise. The social and political implications of slower growth become more apparent. The social contract that traded freedom for prosperity is tested as prosperity becomes harder to deliver. 2030 onwards, China faces the challenge of becoming an aged society before becoming a wealthy society. The dependency ratio, the number of non-working people relative to working people, rises sharply. This puts enormous pressure on the economy and on government finances. The question becomes whether China can successfully transition to a consumption-led, innovation-driven economy before demographic decline makes that transition impossible. The two bombs tearing China apart, the debt crisis and the demographic crisis, are not separate problems. They are deeply interconnected, each making the other worse. The debt crisis was created by trying to maintain high growth rates through excessive investment and construction. But that strategy only works if you have a growing population to fill the apartments and use the infrastructure. The demographic crisis means that strategy no longer works, but unwinding it creates a debt crisis because so much of the economy depends on continued construction and investment. This is why the next 18 to 24 months are so critical. The decisions made now about how to manage the property crisis, how to support consumption, how to address demographic decline, will determine whether China experiences a soft landing or a hard crash. The optimistic scenario is that China successfully transitions to a slower growth, consumption-led economy. Growth settles at 3% to 4% annually, still respectable by global standards. The property crisis is gradually resolved through a combination of government support and market adjustment. The pessimistic scenario is that China enters a lost decade similar to Japan's experience. Growth stalls, deflation takes hold, debt levels become unsustainable, the economy stagnates while the population ages rapidly. The catastrophic scenario is that the property crisis triggers a broader financial crisis. Banks fail, capital flees, the currency collapses. Social instability follows. Which scenario unfolds depends on choices made in Beijing and on factors beyond anyone's control, like global economic conditions and demographic trends that are already locked in. So here's my question for you. Can China escape the doom loop of debt and demographics? Or are we watching the end of the Chinese economic miracle? Share your analysis in the comments below.